शानदार. Now, one of the key facets of reviving any economy in the world that has been hit by something as severe as coronavirus pandemic is to revive credit growth. Credit growth is a challenge not just in India. The demand for credit has been muted in several large economies around the world. But in India, there is a specific context and background that adds to the conundrum and the challenge. Credit growth in India had already begun to be muted before coronavirus and the pandemic actually hit and shook up our economy. In the backdrop is an overhang and a lag of NPAs, non-performing assets, that have accumulated on the balance sheet of banks over several years. A cleanup has been in process for quite some time now, and in the middle of that, coronavirus has hit. Now, the primary effort and goal is to help companies survive, those who have been hit because of coronavirus, as well as allow banks to rebuild and make sure that their asset books are clean. At the same time, banks also have to lend out. And here is where the question comes. Despite several measures being announced by the Reserve Bank of India, credit offtake has not really improved. On the other hand, demand has also been muted because of a slowing economy. So what can be done and what should be done to revive credit demand? Today, I'm pleased to speak with an excellent panel of speakers on the India Revival Mission. I want to welcome first Mr. Arijit Basu, who's Managing Director of State Bank of India, Niranjan Hiranandani, who's MD of the Hiranandani Group and President of ASSOCHAM, Dilip Chenoy, Secretary General of FICCI, also joins us on the show today. Welcome to all of you, and thank you for speaking with us here at ET Now. Mr. Basu, let me first begin by getting your prognosis of what the issue is. We know that credit growth has been sluggish, it has been slow. There are two ways of looking at it. One is that banks are risk averse. They've already, burnt their fingers once, and in the middle of a pandemic are being very choosy to whom they lend. And on the other hand, there just isn't enough demand. How do you see the situation?
Two quick responses to that. One is I will bifurcate into what has happened since COVID, which is basically this financial year, because COVID lockdown started on March 25th, and how the lending scenario has panned out from 1st April till now. And I think when you mentioned in general that there is a slowdown in credit growth, you were alluding to the earlier years. Now let's first take the current situation. In the midst of COVID, I think all banks have risen to the occasion and gone all out to lend. And that is visible in the growth that has happened in spite of economic activity being slow. We are aware of in the MSME sector, the additional 20% line that was given through the government guaranteed scheme, almost 1,20,000 crore has been disbursed. For MSME sector, that's a fairly large sum. In addition to that, the banks reached out and gave a 10% lines, which was first announced by State Bank, and so on and so forth. And as far as projects are concerned, I think the project pipeline continues to be strong for SBI, which is the leading bank. And of course, the sectors are not as diverse as it can be, but there are some specific sectors in which the project pipeline is strong. And in the retail sector, of course, there has been, the personal segment has seen significant growth, but housing loans, etc., they had slowed down a little bit for obvious reasons. People were in lockdown, and that was not the right time to come out and look for buying houses or cars and so on. But I think as the festive season is approaching and the lockdown has sort of ebbed out, I think there will be a demand for growth will come back. But I think your question was also predicated on what had happened in 1819 and 1920. There, very quickly, let me put it, we have said this on behalf of SBI earlier, that while our overall credit growth has been 9 to 10%, especially in the corporate book, you must understand that two things happened. One is the net reduction, the reduction in the NPAs were so much higher than it was on an average. For example, for SBI, our average reduction of NPAs, which brings down your outstanding in the corporate loan book, used to be around 5,000 to 2,000, 10,000 crores, say in 13, 14, 14, 15, 15, 16. You look at our book every year. In 18, 19 and 19, 20, this was on an average 60,000 crores. So whatever new loans and sanctions that we gave, we had a minus 50,000 crores hitting us in these 2 years. In spite of that, in 18, 19, in SBI, our corporate loan group growth was 14%. If we add this back, it was as close as 18, 19%. In 19, 20, we were around flat. But if I add this 50, 60,000 crores back, it is almost 9%. On top of that, we have a large uptick in NCDs, that is the non-convertible debentures. So companies can borrow, corporates can borrow either directly from the loan book or through NCDs and CPs. The NCD CP was again about 40,000 crore extra for SBI in 1920. So if you look at that, and I'm just taking SBI example because that is what I deal with day in and day out, but that has broadly been the picture overall. And in an economy which, for whatever reason, had slightly slowed down, any growth beyond this could have led to certain issues. So all good companies which have come forward, who have a good business model and have come forward to ask for, who have requested for loans, they have all been met. I think where maybe our bank and some of the banks had slowed down was in the MSME sector. And there, I think the revival has come after the COVID. And I think some push is being given by our bank, and we will come back on that. So just one broad, without getting into details, one broad response to your question.
Mr. Basu, let me refer to the exact figures that I'm quoting when I say that credit growth has slowed down, and I'm not speaking about any specific bank over here. I'm referring to RBI numbers which compare July 2020 to July 2019, which talks about gross bank credit going down from 11.5% to nearly 7%. In this, the drop in agriculture has been from 6.8% to 5.4%. In industry, the drop is the sharpest, from 6.1 to 0.8%, so sub 1% there, and so on and so forth. It's understandable when you compare to the year before, because these are unusual times and unusual situations. I get your point that there has been a pump up from April onwards, with of course a lot of government efforts and RBI, etc., banks also stepping up. That does not remove from the equation the question of slow credit demand. Do you think that's a real concern?
Credit demand, yes, that comes from the corporates and the companies who are in business. So the corporates and the companies who are in business, they will have demand for credit when they wish to grow their book. Now, in the lockdown situation, for example, it's not to be expected. The first thing that they would like to do is to conserve cash. So the dispensation that was given by RBI of having a moratorium, many of the companies and corporates actually applied. And then as the lockdown sort of started getting removed from June onwards, they found that their cash flows had significantly increased. So what they did was, some part of it they conserved, some part of it they repaid. But for the growth capital, that is when they have to do a planning that this is my, target for sales for 2021. This is what I would like to achieve in 21, 22. I think there is still some lack of clarity. But let me here put in a positive note. The sense that we got from the corporates that are there in the SBI book, and SBI book is a very representative book. Although we do not serve all the corporates, I think almost 70 to 75% of them have some kind of relationship with us on the lending side. That is one. And of course, in project finance, we are there in any major project. So, and we have seen the worst of times, when the AQR and RBI started and all the large projects started, toppling over one by one, and then how the books were cleaned and how they came. So very honestly, my personal sense and the sense of SBI also was that as on March 31st, 2020, not just for SBI, but for the entire banking system, whether private sector or public sector, was in very good shape. And this also reflected the position in the economy. So our sense was that if COVID had not happened, 2021 itself would have seen a fair uptake, in terms of economic growth. Last year, economic growth was about 4.7 and thereabouts. I have a feeling that this year there would have been, how much it would have been, I don't know, but there would have been an uptick. But now we have to face the COVID situation, in which not only these 26 sectors which have been identified by the committee, but virtually the entire economy has got impacted. And we have to look now as to what is happening since the lockdown process has ended. We have lost 3-4 months. This minus 23.4, it's known. There was no economic activity in April and May. You only had a little bit in June, and you would only expect the economy to be negative. But I'm fairly positive that July to September will throw better results. And from the festive season onwards, unless we have something very major happening out of COVID once again, which hopefully with God's help, we will not be required to face that. In which case, I think the companies will now once again start looking at it. There are green shoots which are coming. The auto sector is looking up. Steel demand across the globe has increased, so there is a traction in that. The government also has put in measures. Power generation, etc., has come back to fairly normal levels. Cement demand is there. And I think one or two crucial sectors, including Mr. Hiranandani's real estate, they need to come back. And I'm sure that that will be seen from now on. It will not be a completely painless position, of course, to expect that because companies' balance sheets have got impacted. They have to take a lot of effort, and the MSMEs have got impacted very badly. So these support has to be extended. I think the government is doing a lot. All the schemes that have been announced, it's just not the 20%, it's the subordinated debt in terms of equity support and so on and so forth. With all that, I think we should be able to come back. But then demand will only come once there is some clarity and visibility as to how much of sales a company would be able to do.
Let me take that perspective then to the corporate side. Is it uncertainty which is holding back potential borrowers, and that is also leading to a muted demand for credit? Of course, for individual borrowers, all the examples are there and pretty apparent: unemployment rates, uncertainty in future incomes, etc., etc. But Mr. Hiranandani, tell me from the side of corporate India, from that perspective, where do you think the pendulum swings? Is it about not having enough appetite for credit, or in your view, are banks truly being wary and a bit risk averse?
I think Tamana, the issue is very clear. The COVID has hit so badly that in the initial stages, people were just thrown off their feet. Nobody had an idea initially, and hence what Mr. Basu said is correct, that we were not able to do anything except look to conserve cash. That has changed definitely, and certain industries have picked up. Certain industries like steel, like some of the textile units and others have got back to the feet. Real estate, I would say, is back about 20-25%. The other industries like aviation, hotels, travel, tourism is floundering still in a terrible way. So to say that one decision or one thought covers all the sectors would be wrong. But in reality, what has happened is that some of the sectors have been able to spring back to the situation while some are floundering. So what is really required now in the situation that it is, I think the government, the finance minister, the Reserve Bank of India has done a wonderful job on the supply side economics. And that is where Mr. Basu is absolutely right, taking care of the NBFCs, taking care of the MSMEs and other aspects by giving certain deals to them have certainly been very, very useful. However, the demand side is what really needs to pick up now, because in spite of the fact that we are now moving back the economy to normal or close to normal over a period of time, calibrated wise, I think what is needed is a push from the government on the demand side. Maybe a cut in the GST, something on the lines of what Maharashtra government did in the case of stamp duty correction by 3%, from 5% to 2% for the next 4 months, and then 3% for the next 3 months. The demand side instigation. I think similarly, something needs to be done in the automobile segment for the purposes of GST, and other segments in terms of hotels, restaurants, and others. So I do believe that while the supply side economics, which Mr. Basu talked about, has definitely seen some improvement over the last 30 days or so, I do not see the demand side pick up in the similar fashion. And I do think that a time has come where the government will have to relook on the demand side in a very, very serious sort of way. And I'm hopeful that if that happens, then the negative growth which is happening today will, by the first quarter of next year, 2021, will see a positive growth. But if you don't push the demand side, then we will still be floundering, and it will take much more time for the economy to turn around and get to action. So while I am extremely bullish that industry will come back, real estate also will come back, and talking about real estate specifically, since it's my industry, I have to thank SBI's Swami Fund for the work that they have done, which is of 25,000 crores of rupees. But by now, we need at least 5 funds of the size of what the Swami Fund is. We need about 1,25,000 crores for doing the last mile funding in the real estate in the last 6 months. The situation which has taken place is a larger number of projects are floundering. So we do need a 5x in terms of investment into the last mile funding. So in summary, we think supply side, good improvement. Demand side, languishing, still long way to go, needs much more incentivizing. Specific industries need a better injection than what has happened. And I think if these 2 or 3 things are done by the government, and they are capable of doing it, I think you will see economy getting back to normal. Of course, if the vaccine comes in December, then it'll happen faster. But if it doesn't, the herd immunity by March of 2021 will actually mean that it will take another 2 or 3 months for the economies to really get back to normal.
But is it all about COVID and the vaccine alone? I just want to bring to your attention once again, and Mr. Chenoy, I'd like your perspective on this aspect. I referred to it when I began the show, that the whole credit growth, credit offtake situation in India should be seen in the backdrop and context of what banks have been dealing with, why they've needed recapitalization as far as public sector banks are concerned, why private sector banks are shoring up their balance sheet, is because there has been a massive NPA overhang which continues to be there. If you look at it in that context, what do you see as the true situation? Are there today no companies out there that are in urgent need of liquidity or credit to actually stabilize themselves, and they aren't going to banks which are sloshing with funds? Is that the true situation?
So Tamanna, there are many questions in that one question, right? So the first thing I want to actually say is that, you are right. So if you look at the banks lend to one category of borrowers, the NBFCs lend to another categories of borrowers. Sometimes the NBFCs lend to those categories of borrowers which actually create the demand for companies to actually borrow from the banks. So over the last few years or year and a half, there's a very strange situation, which was in your question. Banks were deposit rich but equity poor. NBFCs were equity rich but deposit poor. So the whole financial system actually got a bit derailed because those who wanted to lend could not lend, and those who could lend did not have the ability to lend. So that was one kind of a situation there. The second part of your question was that given the NPA situation, And given the various things that actually came into the different RBI circulars, different rules, regulations, etc., a lot of the time of bank and NBFCs and all was actually spent in addressing and cleaning up what was there. A disproportionate amount of time. In a normal situation, those people who were involved in those aspects would have been out actually seeking new areas of investment and new programs, etc., there. And then what happened was that the impact was that, if one as an individual, if just to take Mr. Hiranandani because he's on the show, if he had existing loan and he wanted to get into a new business which required long-term finance, and banks were unable to give him long-term finance, he was reluctant to take it because a default in this new project, which is going to get maybe profitable in 6 to 7 years, and the loan that he was getting was only for 4 to 5 years, he would not actually go for that, because if he defaults in that, all his other loans under the group scheme would actually be impacted and going forward, and he would have. So there was a reluctance of existing business people to actually go into new projects and new things which they wanted to actually do. So that was the second kind of thing actually playing out in the minds of a lot of entrepreneurs. And the third issue was actually not the availability of funds, but the cost of funds. And therefore, in addition to all the demand side interventions that Mr. Hiranandani talked about, there's a huge need to look at an investment bank type of situation here, which will actually afford long-term finance at low rates, and then you would see a different kind of credit offtake going on in that area. But then inbuilt into your question is another question which you talked about. There are three types of actually financing. So, you have new projects, and you have existing projects, and you have working capital finance.
Right.
Now, in all the three areas, there have been some changes made post-COVID, right? But the problem is, because in April, May, June, there was hardly any income, the normal covenants of banking actually took a spin. So, if you follow the traditional covenants and, you did not take recluse under the emergency credit guarantee scheme for the MSMEs, or, under the relaxed, working capital norms, you could not get access to either working capital or other funds because of the COVID situation. And that has also led to you quoted July 19 and July 20 figures. A lot of that was because of this inability for the system to adjust very quickly. And in that context, which we were referring to earlier, the restructuring, one-time restructuring of loans, and the 26 sectors where they have prescribed norms, and the other sectors coming under the other ratios, is a very, very positive step going forward. But existing projects are stopping to draw funds because either the machinery is delayed. And interestingly, even the machinery, if it has been arrived, a lot of people are not releasing it because the technicians to install that machinery cannot travel. So if you look at it in a different way, you are actually finding different kind of blocks in existing project finance being taken up, and new projects. And there are two types of new projects. One in which everything is being done, and some of the owners are very confident, and they have the ability to actually work in the system and get it going. But the others are not too sure about demand. So they, as Mr. Basu rightly said, the visibility of 2021 may be there, but 21, 22, the visibility is not there. And how does an industrialist actually put up a new project proposal, and how does the banker evaluate in the current situation to look at project finance going forward? So these are the three different things, and working capital is the same issue. People really wanted working capital to bridge salary and fixed costs and electricity costs and all of that, but inventories or the collaterals which are required, or the normal ways that you actually collateralized the bank or the working capital, were not actually available. So these were the different challenges which I think, collectively the government, the banking sector and industry have been addressing. As Mr. Hiranandani said, some steps have been taken, more need to be taken. But I think, what is important is they're taken very, very quickly.
Thank you, gentlemen, for joining us today on this very special series of India Revival Mission.